Martin has a question here in the Q&A. I see there's some in the chat box. When we're taking the unemployment numbers, the PPP, what happens when there's some evictions and bankruptcy? Will that hold the economy back?
Oh, for sure. I think that's why, I ask this question a lot. What's my symbol? What letter of the alphabet is the economy? I'm not going to use a letter of the alphabet. I'm going to use the Nike swoosh. We went straight down, and then we're going to slowly grind higher. Creative destruction. You are going to hold, I think the next round of stimulus will allow to keep people in their houses and prolong rents and things like that. I think there'll be some more money for small businesses to continue going if they need it. I think it's less going to be on the unemployment line because they want people back at work. But that's where this second round of stimulus will help keep us going, because we're going to need some more money to get us through September. I think we need money to get into September, and that's probably half of what we did round one for round two, and you'll get it for August, September, with the expectations. Listen, we're having this call in September, and there's not a vaccine or an antivirus, and we're going in a volatile direction. Whew, that's going to be a bad deal. But I just don't think science is going to lose. You have too many. Moderna is about to create in excess of 1 billion vials of their vaccine. That's a lot of damn money to spend on 1 billion vials and assuming it's not going to work. That's incredible. Pfizer, AstraZeneca, all in the marketplace, creating hundreds of millions of vials already. And Regeneron's already manufacturing their pill, their therapeutic. One of these has got to work. Hell, just the plasma that we have out there. They're coming up with a plasma pill. So rather than have to go and get people donate their plasma, you'll take a pill that'll replicate plasma from someone who's recovered. That's going to get you out of the hospital. That's in phase 2 as well right now. So I just think science wins, and that's why I'm willing to have an equity on a balanced account, which is normally 60-40. We're about 53%, 54% equity. We were 68 before this happened, by the way, and luckily for us, we had started to dial down going into this a bit. We had come back down below 60. But even us, we're in a conservative posture here. No small caps in the portfolio, some mid caps, very little international, trying to participate and protect because you really don't know what's to come.
And on a positive front, from your friend Steve, he asked, can it be said that a market correction of 10 to 15% actually might long-term be healthy for the markets?
I agree. I would like to see a brush fire. I think brush fires are good. We had a forest fire, but it got put out quickly. A brush fire, you clean up some of the irrational exuberance, especially the big tech names. Let's clean it up. Let's go back down. We should be down 10, 15% on the year based on the economic data and the lack of vaccine and how much we're going to open. We should finish this year probably down 10. If we end up, positive on the year, it's only because everything went right and the market's pricing that in, including could you imagine if we have a contested election like we did under Gore and Bush? You already got the president saying if there's mail-in ballots, he's not backing down. Oh my gosh, I don't even want to know where that begins and what that would do for the economy and the markets themselves. So there's so many unknowns. I think it's hard to be aggressive here, and to me, a brush fire would make some sense.
Right, cautious, diversified is where we're going. We're not being overly confident right now. So
too many things we don't know. We're not managing money based on the economy. We're managing money based on the speculation that science, and we can be adults and not get older people sick from getting infected.
Right. And let's go to Ryan's question. He's asking about corporate debt levels. We're already high pre-COVID. Now with the Fed's purchase of corporate bonds, high yield spreads are returning to levels pre-COVID. Is this a ticking time bomb? And are you concerned about the impact of the Fed's policy in terms of driving a huge equity bubble due to the lack of high yields on the bond side? We have some interesting questions out there.
You get some really smart people on this call, but I don't know. I love it. We should do this every week. There's 3 questions in there. So I'm going to take the first one, corporate debt. The corporate debt issue, you're not going to believe this. I'm not worried about it. It has tripled, but so has the economy gotten bigger, in fairness. And it's like going to buy a new home. When you're buying a new home and you're able to get your financing costs so low, you can buy a bigger home because your net rent payments or net mortgage payments the same. That's kind of where we're at. They expanded the size of the debt they have, but their financing is for so much lower, they're able to pay for the debt. So anybody with a BBB balance sheet or higher has not only the Fed to back them up, which so far they spent about $1 trillion doing it, and a lot of the companies don't want them to buy them. A lot of companies saying, yeah, I'll need to let you know if I need you because it's a bad sign. It means you're really in a default situation if they start buying your debt, United aside and things like that. But, when the corporate debt bubble for now, because financing costs are so low, I'm not overly concerned. When that debt rolls over, if they've got to refinance it at a higher rate, that would be a reckoning. So down the road, 4 or 5 years from now, 2 or 3 years now, assuming interest rates go higher, it could be a reckoning, but they're doing the bonds out at 10 and 15 years. People are paying you're getting 10-year bonds being sold at 1.5% for 10 years. That's the rate of inflation for 10 years, but they're very popular. So I'm not too worried about the corporate debt bubble. I'm not worried about the federal debt. The entire federal debt of $21 trillion is being financed at 0.5%. It's ridiculous. And they're finally issuing longer-term bonds. If I was Mnuchin, I'd be doing 50-year, 100-year bonds. Push the debt out until we're all dead and let the next generation worry about it. And then, we'll be laughing from heaven, I guess. But, in all seriousness, you have an opportunity for very low interest rates. The Fed, the second part of the question, creating, stepping in, and what does it do for interest rates and defaults? The Fed's going to let anything below BBB, I think, default, and that's healthy. Companies that were staggering going into this, yeah, you're going to get. There's a reason why J.P. Morgan and the rest of them have about $100 billion total set aside for defaults. It happens, and that's the risk you take being in high yield. And the question about spreads, you're right. Your high yield spreads have come in. You made a bunch of money. Sell some of that. Take the profit and run. I mean, I can't tell people enough that that's an opportunity for you to. You're being told by Jamie Dimon, arguably the smartest guy in the damn country when it comes to this stuff, saying we're expecting significant defaults, and you're still holding on to your high yield paper. Well, I can't help you there. This is an opportunity to rotate into higher credit quality. And the last,
go ahead.
The last piece, because this is a 3-part question. Whoever this guy is, I'd like to meet him or girl. An equity bubble is interesting to me. I don't think you get an equity bubble with interest rates this low. I do think valuations need to recover to get us to a fairly valued market. But an equity bubble would indicate that we're 30, 40% overvalued. And maybe at a couple of big tech names you are, but by and large, that's not the case. So I do think you're expensive. The problem is I can't tell you how expensive we are with rates this low and lack of earnings data. So I don't love the stock market here, but that's why if you rotate towards larger companies with good balance sheets and cash flow, you'll be fine in late waves of volatility. Beyond that, bubbles are a big word. You don't get bubbles unless there's irrational exuberance in the market. And I don't think you have that today. I think we have come back too far too fast, but not to the point where we're not up 20, 30% with people borrowing money to buy stocks like the tech bubble in 2000.
Phil, you got a couple more minutes?
Sure.
All right. I want to get some questions over to you, and then we'll try getting some of these Q&As. Get all your questions in if you have any questions. We're getting a lot of good questions. Thanks, everybody, for joining. All right. So I know the debate over the last 10 years is when the value stocks and the value area of the market, when are they going to have their day? And last week we saw the value up. Growth. Yeah, and today you're right. The NASDAQ came down. So when's it finally time with the growth stocks just rising that value has its day?
If we come out of the recession. If we get out of the recession and the economy starts to open up, go to the banks, go to industrials, go to manufacturing, run out of utilities, go to consumer cyclical companies. Why? Because those cyclicals are going to start making money. You can even touch out and go jump into energy, and oil is up again today. You have a chance to go back to traditional core economy stocks, the Home Depots of the world, because that's what's going to do well coming out of recession. In a recession, it's growth, 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 growth. But by the way, what's different this time is I would not expect the growth names to be obliterated. We have had a secular change in who we are as a country, who we are as a globe. Look at what we're doing right now. We're communicating in a way we've never communicated before. I can trade billions of dollars with people working from their home. Think about retail online sales up 30% year over year. Prime Day is coming up. Watch Amazon go up another 5% because people bought a whole bunch of stuff they didn't need. It's a different world. And when the older population doesn't crave to have more stuff because they're more worried about running out of money and holding on to what they have. Think about travel, leisure, tourism. By the way, you want to buy inexpensive stocks. Go buy yourself a Marriott and laugh at everybody else 2 years from now. But those are the kind of names that are going to do well if we come out of the recession. If we don't, that this thing doesn't get solved, you got to stay in growth. And that's because that's what's driving the economy. So therein lies your opportunity. Make a portfolio change. I have value in the portfolio right now, but I'm overweight growth. I'll go to equal weight and underweight growth if we begin to really turn on again at full steam. But by the way, growth is going to be the leader for the foreseeable future. The spread between growth and value right now is 32%. It shouldn't be that wide. It should be probably about 10, but not this one.
In my last question, I know I like ESG, And especially with everything going on, big companies are socially responsible, or trying to become socially responsible. Renewable energy is on the rise. Social movements, especially with everything going on right now around the world. What are your thoughts on ESG investing? And for those who don't know what ESG is, it's essentially socially conscious investments.
Yeah, ESG is an interesting one. It's funny because, in my opinion, it's kind of a silly word. It really is, in that every company should have always been doing ESG. You do want good corporate governance. You do want good, sound policies. You do want to be pro on the environment. And what we found is there's a lot of companies who always did it. Now that someone's adopting ESG, it's, what, were you a bad company before? It's kind of unusual to look at the nomenclature that's being thrown around. I'm actually a bigger fan of targeted investing. You want to protect the oceans, companies that are working on that. You want to protect the environment. You want to focus on green energy. So I think targeted use of monies in a way that have a specific purpose investing, to me, is a lot more interesting than ESG. Social responsible is an interesting tagline. We run a social responsible portfolio. But what I think social responsible means, and what you think it means, and what everyone else on this call means, is probably something different. So I think the right answer is, if there's something you're passionate about, and the returns should be there, we've seen the returns be okay. If it's something you're passionate about, I would focus on a topic that means to you. Because I think every company is going to have no choice but to be ESG, especially what's going on with, the civil rights movements, or the rights for folks who have been underprivileged, and think about what we're doing for the lower sector of the economy. And ESG is going to be something every company has to do. Mm-hmm. Beyond ESG is where I think you want to focus for you personally, and there's ways to do that now, which is pretty cool.
Question here in the chat box: where would the markets have been without the Fed support?
That's a good question.
There was the Fed support. I mean,
there's two Feds: federal government and Federal Reserve.
Right.
Without the federal government, we would be in a depression. Without the Federal Reserve, we'd be in a deeper recession. The Federal Reserve, for all that they didn't have to do too much yet. They really haven't done that much yet. They bought about $1 trillion worth of bonds. They put money on the front end of the curve. They bought more bonds into the Federal Reserve as well. So you could argue the whole kit and caboodle is $3 trillion, but they haven't bought risk assets. Remember, in 2008, they bought a lot of risk assets. They physically owned companies. That's not really the case right now. So the Federal Reserve is saying they're going to be accommodative, keeping interest rates low, making sure we have liquid markets, giving companies the opportunity to borrow money. It's been more about being there than actually doing a heck of a lot. I really don't want to do much for it. I don't want to balloon the deficits more than they have to be. The federal government combined with the Federal Reserve got us here. If not, we would have been in a depression. You'd have 50 million people out of work. That'd be a bad day.
Bill, you deserve your own TV show. Seriously, one day I wouldn't be surprised if you got your own TV show.
No, nobody likes this. This is boring. 99% of the country could care less.
I can say that, hey, I had him on the first ever Associated Tuesday think tank. It's a historic moment with Blancato. But hey, I appreciate it. We had a great turnout. Surpassed my expectations. We had tons of great questions.
Yes.
Phil, Phil, thank you so much for being here. All the Associated guys, thank you so much for being here. Hopefully everybody enjoyed. Hopefully our family, clients, friends, they enjoyed this. We're hoping to do some more very soon. Feel free to shoot me an email if you have any questions. Evan Vladem, my email is evan@afc-ais.com. Definitely happy to connect you with Phil. He has some great insights, so I'm very lucky to be working with Phil. Again, shoot me a note. You know how to reach me. And thank you guys for coming out. And we'll do this again soon.
Thanks, everybody. If you're bored, I'm on Fox tomorrow at 2 o'clock. If you're really bored, with Charles Payne. It's on Fox Business.
There you go.
Thank you for having me on. It's an honor and a privilege. And you're lucky to work with the gang from Associated. They really are spectacular people. Evan's dad, Paul, and Steve are very good friends of mine, people I respect and trust, and have been mentors to me. I've learned a lot from both of them. So you're lucky to be teamed up with them. They're great people. Luana's who I don't want to leave her out. She's a sweet person who's also very good at this. You're all lucky to have such a strong firm to partner with. But thank you for having me on. It really is a privilege. I appreciate it.
All right, guys, that's a wrap for the first ever Associated Think Tank Tuesday. I think we have a name for this thing.